Hello, I'm Hugh from Buzzacott, and today I'm going to be talking about fund accounting for Academy trusts. So fund accounting is one of the key elements that underpins a set of Academy financial statements. So you'll see straight away when you look at the statement of financial activities that Academies have got these column-based sets of accounts split by fund. If you look on the bottom half of the balance sheet, the information is split by the different fund accounts on the bottom half of the balance sheet. So you have unrestricted funds, restricted general funds, fixed asset fund, pension reserves. So all these different elements of the fund accounting. So that's really important to get right in the financial statements, and it's particularly important because one of the most key bits of information that you want to get out of a set of financial statements is how much available revenue funding that you've got at the end of the year. How financially stable is it? How much funds has this Academy Trust got? So it's important information, but it's also potentially difficult information to derive and to produce in your financial statements. And that's because Academy accounting software systems don't tend to record all of the information by fund during the year, and therefore you can't just press a button and easily report on each of the fund balances in the Academy Trust. And that's because when academies incur expenditure, say staff costs, it's not inherently obvious which fund they relate to. So whether a person, their time relates to GAG funding or startup funding or pupil premium, it's often split across a number of funds, and therefore that doesn't tend to be entered on a transaction basis. It gets recorded at the end of the year. And so this is getting the fund accounting right is an essential part of preparing the year-end financial statements. Because it's important and because things can go wrong, it's worthwhile spending a bit of time going through and seeing what the key issues are with preparing a set of financial statements and getting the fund accounting right. So with the next slide, that's what we're doing today. You can see the agenda here. We're going to have a look at some of those fund accounting principles, some of the different funds that we'll see in Academy accounts, how the information is put together for each of those, and then highlight a few important checks to perform to make sure that the fund accounting is correct in your financial statements. So let's begin. The next slide shows the statement of financial activities, and as I've said, you can see the fund accounting immediately on this statement of financial activities. You've got a column-based set of accounts which represents the funds. You've got the unrestricted funds, the restricted general fund, and the restricted fixed asset fund as separate columns within the statement of financial activities. The principle behind restricted versus unrestricted fund is all down to the donor's wishes. So if the person or the institution granting you the money has said it's got to be spent on particular purposes, then it has to be presented as ring-fence restricted funds in the account. So it'll sit within either the restricted general fund or the restricted fixed asset fund. The purpose of having two restricted fund columns in Academy accounts is that we're distinguishing between revenue funds, so funding for your day-to-day operations, and income that's restricted for fixed asset purchases, so capital funding. So they've got separate columns in the accounts. The unrestricted fund is funding that, or income that has no restriction placed on it by the person giving or the institution giving the fund. So this is things like lettings income, where it's just invoice money and you can spend that income on whatever you want, or maybe donations that are generally towards the Academy Trust and not for a particular purpose. Funding that you can spend on whatever you want inside the object. Just a note on this page, goes within the restricted general fund. So this is the local government pension scheme deficit and the related adjustments in connection with that. So you'll see the total of that column is negative, and the reason it's negative is because that total fund balance includes that obligation to pay those local government pension scheme deficit over a period of time. So that all goes through that column. Otherwise, the restricted fixed asset column is separated off just so that you've got the capital funds separate and the depreciation charges also separate in that column. So you can see the 949 expenditure in the restricted fixed asset fund column. That's largely depreciation charges. And so we're separating off any surpluses or deficits arising from fixed asset income and depreciation charges from the day-to-day revenue, income and expenditure. So on the next slide, we see how this all translates to in terms of the restricted revenue fund. So what we've got here on the slide is an extract from the funds note in the accounts. So one of the notes to the accounts breaks down those three columns into a lot more detail. And so what we've got here is the rows on this is similar to the columns that we saw on the previous page, and the middle column that we saw, the restricted general fund, here is split down into a whole number of subcategories. So we've got the gag money, the startup, the people premium, all the things that make up those restricted general funds, including the pension reserve, as I mentioned earlier. And what this is trying to do is reconcile the opening balance to the closing balance. So we've got the balance brought forward at September 19, and then the income for the year, the expenditure against it. And we've got one column capturing gains, losses and transfers. And so gains and losses, that means your gains and losses on your defined benefit pension scheme, your local government pension scheme. And the transfers is any transfers between funds. So your transfers between funds will always add up to zero across the various funds, and the gains and losses will just be a separate item. And then you've ultimately got your balance carried forward, which is one of the most important bits of information. What are the balances of revenue funds that you're carrying forward into the next financial period? So on this note, one of the key things is how to put this note together. Where do we get the numbers from? As I mentioned, it's not easy to just draw these straight out of the accounting system. So where do the numbers come from? So let's work it through column by column. In the first column, we got balance at 1st of September 2019. Well, that's easy because it was in last year's signed financial statement. So we've got that starting point from last year. The income is normally relatively straightforward. So these categories of income, whether it's gag or pupil premium, it should just come from your trial balance. You should have these as separate nominal codes to separate off these items of income. So it should be a relatively easy process to map that straight from what's on the trial balance. It's the expenditure where things become more tricky. So on your trial balance, you won't have a row that says gag expenditure. So there's nothing we can map here when producing this note that just pulls data from the underlying accounting system and says that's the gag expenditure and allocates that number there. So there's got to have a methodology of arriving at that figure. So how do we do this? So there are certain pots of restricted money that you may be tracking either within the accounting system on separate spreadsheets. So you may have particular ring-fence grants that you receive that you track as a cost centre on the accounting system, and therefore know what the expenditure is. So if you have a particular area of ring-fence money where you know what the expenditure is, you can then make sure that that's input into the expenditure column within this note. You may also be tracking the balance carried forward on some of this income. So for pupil premium, to take an example, Academy trusts are required to track their pupil premium expend and know whether they're carrying forward money at the year end. So you really have to refer back to whatever accounting record you keep for that and those reconciliations, and determine whether you're carrying forward any funds at the year end. So by a combination of filling in those known expenditure column items, or by knowing what you're carrying forward and making sure that that number is correct, you're filling in a lot of the blanks in this table. And what that will most likely leave you with is a balance of expenditure that hasn't been allocated to anywhere else, which you now need to allocate. And often the basis that we do that is on the narrowest restriction first. So it's always better to have funds that are unrestricted if you can. And so what we try and do is say, well, if we've got funds that we can equally allocate to unrestricted funds or to GAG or to other places, then we'll try and allocate it to the most restricted area and then leave flexible funding going forward. What that ultimately means most often is that the expenditure within the GAG row is often effectively a balancing figure. It's the remaining expenditure that you can't allocate anywhere else, and that brings you to your GAG balance carried forward. The other column you've got there, which is the gains and losses and transfers. Well, the gains and losses, as I say, just comes off the local government pension scheme actuarial report. It's the transfers that's the key one to make sure we get right. So the transfers in this case is a very common transfer. It's a transfer out of GAG into the fixed asset fund. So in this case, Coketown model accounts, Coketown has spent £10,000 of its GAG money on purchasing tangible fixed assets, and therefore there's a transfer come out of GAG and gone into fixed assets. So that's a common transfer, and it's important therefore to know for all of the assets that you've purchased where the funding has come from, and if you have purchased assets out of GAG funds, to know what that figure is so you can put that transfer in there. Just note that sometimes you'll see that number is a positive number, so funding coming out of the fixed asset fund and back into GAG, and the reason for that is often that you may receive some capital funding like devolved formula capital, which goes into the capital, the fixed asset fund, but actually ultimately gets spent on revenue items. And so the reason sometimes capital funding gets spent on revenue items is just because of the technicalities of accounting. So two most common reasons are that you purchase things that sit below your capitalisation threshold. So I don't know, academies tend to have capitalisation thresholds between £500 and £5,000. So if you've one with £5,000 and you bought something for £3,000 and didn't capitalise it, but you bought it out of your default formula capital, you might need to do a transfer to then reimburse the other fund that you purchased it out of. So you might have allocated it to GAG and you might be reimbursing your GAG for that. And the other reason is that it may be work that's refurbishment work, say. So it is work on the sort of the buildings, but it's refurbishment rather than improvement work, and therefore it goes as a revenue item for accounting purposes, and therefore it goes through these restricted general funds, but then needs to be topped up by wherever it was funded from. So if it's devolved formula capital, for example. So you sometimes see those transfers in both directions. So just to reinforce that on the next slide, we can see some of these sort of practical issues. So really, as to reiterate the methodology, it's about identifying which funds are already accounted for. So things like pupil premium, particular restricted donations, which ones do you have the information to allocate that expenditure and be clear on the carried forward balance. And then it's a case of allocating things on the narrowest restriction first. One thing I would note is trying to match relevant income in expenditure. So we've got the example on this side of school trips. So if you have school trips income, school trips is a bit debatable whether it's restricted or unrestricted. It depends upon the nature of the agreement that's in place. But sometimes people say it's any money received for school trips must be spent on school trips. Others say it's a case of the parent is paying for a school trip, and as long as they receive a school trip, it doesn't matter what you spend the money on, but it's a delivery of the school trip that's important. So it could be in some accounts unrestricted, some restricted, but the main thing is that you're consistent with the income and expenditure. So if you have the income in restricted, the expenditure goes against it in restricted as well. So an important thing to check there. One other point to watch here is negative fund balances. Typically, we don't see many negative fund balances other than the pension reserve within Academy accounts. So if the fund does go negative, there's got to be a reason for that. The reason we don't see many negative fund balances, effectively fund balances are pots of money. So once that pot of money is empty, you can't keep spending it. So normally the fund doesn't go into deficit. So if you run out of GAG funds, you normally then have to allocate expenditure against the unrestricted funds rather than just to continue spending the GAG beyond zero. So those are some key practical issues to watch out for. On the next slide, we start exploring the unrestricted funds. As I said, these are kind of areas like the donations that aren't for a particular purpose, just generally towards the Academy Trust, hire facilities, and I say things like school trips can be unrestricted in certain cases. So it's about what costs you allocate against these. It's not always easy to identify which costs should be allocated. Certainly if there's direct costs like the school trip example, if there is a direct cost to the school trip, to allocate that. Sometimes it's a sort of proportion of a person's time. So for example, hire of facilities, you may not have a particular lettings person, but you may have someone who spends a bit of their time on lettings, and so it's materially accurate to allocate a proportion of that person's time over to the costs of hiring out facilities. And there may be allocated support costs that you need to attach over to that, so all the overhead costs, if that's material, which it sometimes is, sometimes isn't, depending on the Academy Trust, but worth thinking through. But again, the key issue is not mismatching the fund accounting. So if you've got the income in one column, you'd expect the direct costs related to it to be in the same column. Sometimes you can have capital purchases from unrestricted funds. So we've talked about capital purchases from GAG and the transfer there. There are different options as to how to account for this. In theory, you can have fixed assets sitting within the unrestricted funds because you've purchased those assets out of unrestricted funds rather than sitting in the fixed asset fund. That makes life a little bit more complex because then you have fixed assets sitting in both the restricted fixed asset fund and in your unrestricted funds. So most academies, just for simplicity's sake, keep all of their assets in the restricted fixed asset fund. But in theory, you could purchase and keep those assets in the unrestricted funds. So on the next slide, we start looking at the fixed asset fund. So this, again, what you can see here is just a breakdown of the fixed asset fund element in the funds note to the accounts within Coketown. So this is just a copy and paste from that element of the note with Coketown. And again, this is just splitting down one of the columns on the statement of financial activities, which is rows in this case, into a number of subcategories. So that column for restricted fixed asset fund is split between the transfer and conversion, DFE capital grants, capital expenditure from GAG, and private sector capital sponsorship. You may have other categories, so you don't have to stick rigidly to these categories. And the same is true actually with the restricted general funds. So the principle here is that we're splitting the fixed assets that you're holding, so all the buildings and computers and other assets, by the source of funding. So if we've, for example, purchased, say, some computers out of GAG funding, we will be separately accounting for those within this GAG fixed asset fund as a subcategory. So say we've got 7,000 there brought forward. So if you imagine this is computers, we've got a net book value brought forward of 7,000 of computers. We then purchased £10,000 worth more of computers during the year. So that was purchased out of GAG funds. So we did a transfer between funds for that. And then we allocated £3,000 of depreciation to those computers as they depreciated in the year, which gave us a net book value of computers for £14,000 carried forward. So these balances are represented by a series of assets and their net book value. So how do you account for that? Well, really the only way to produce that information is if you've got a fixed asset register which tracks all of the fixed assets and their brought forward net book value and their depreciation charges in the year, and that on that fixed asset register you track the source of funds for each of the assets. And so by tracking the source of funds, you can then produce this note, because then you can just filter by the asset gag money, and then you can see what the brought forward and depreciation and carried forward balances are for that. So that means that if you don't already, you should on your fixed asset register track what the sort of funds are. Very difficult to do if you haven't been doing it already, to go back through all the history, but certainly prospectively, if you're not already doing that, it should be tracking the source of funds for each new asset. So that should enable you to put together this note, and it's important that that depreciation, for example, is allocated across the different funds to retain the integrity of the net book value balance carried forward. So on the next slide, we start to explore some of the issues around the sort of fixed asset fund. What we see mainly here is just different sources of funding, like your money, fixed assets funding from GAG, from SIF, or from your single central allocation if you're a MAT. What you may also have, just to note, is Salix loans. So Salix loans can be a bit debatable for how you treat these in terms of the fixed asset fund. So let's just think through what happens when you get a Salix loan. So Salix loans are these energy efficiency loans. And so you get the cash from the ESFA, but it's in the form of a loan, so it's not a grant. So you won't see it coming into the income column in this fixed asset fund notes. That's the second column. You haven't got the column headings on there, but the second column is the income column. So you've got no income coming in there, but you have got cash that's received in order to purchase fixed assets. This might be windows or something like that for energy efficiency purposes. So which fund does the asset get purchased out of? So there's some arguments to say that, well, your funds, ultimately these have to be funded by your own revenue funds. So ultimately that's the case. You can't avoid that. All you've been given is loan funding. You've purchased the asset, so you've spent your own funds on this. But it's a case of the timing of when your funds take the hit for that. Do you charge that? Say you had a 50,000 Salix loan. Do you do a transfer in year one from the restricted revenue funds or the unrestricted funds into the fixed asset fund for that in year one, or do you spread that over the life of the Salix loan and only do the transfers as you pay it back? That is a bit of a debatable point. So we did see different treatments in different sets of accounts depending on the underlying situation, but it is an important one to plan for your reserves, because obviously when you're sort of planning your reserves for the year, it makes a big difference if you suddenly take that 50,000 hit from your revenue reserves all in 1 year, or if you do it over a period of time. But if you do put the Salix loan within the fixed asset fund, then obviously that still needs to come out of the revenue funds over the fullness of time, and you will be getting those charges each year to the revenue funds as that Salix loan gets paid down. So definitely one to think through there if you've got Salix loans. So the other key thing on the restricted fixed asset fund is how it relates to the net book value of tangible fixed assets. So typically, in lots of Academy sets of accounts, the value on the fixed asset fund is exactly equal to the net book value of fixed assets in the account. So if we have 10,125 as we do here on the fixed asset fund, you might expect that on the top half of the balance sheet you have 10,125 of all of your fixed assets, your land and buildings and everything else. However, there's lots of situations where that's not the case. So we've talked about the Salix loan just there. If you did have a Salix loan in here, that would be a reason for a difference. You might also have some money that's not been spent yet on the fixed assets. So a lot of Academy capital work goes on over the summer. And so we often see that there's a part finished capital project over the summer, so not all of the capital funds have been spent. So there's some cash sitting here in the fixed asset fund. So if you took the example here, we just make up an example. We've got those DFE capital grants of 200,000 coming in the year. Supposing we'd only spent 100,000 of that by the year end, we'd still have 100,000 of cash sitting in the fixed asset fund. And therefore, we might only expect to see 10,025 of fixed assets sitting on the balance sheet, and we've got 100,000 of cash sitting in the fixed asset fund. So that's fine. So it's fine to have a difference between the fixed asset fund and the net book value of tangible fixed assets, but that's got to be a known and defined number, that difference. So it's got to be a known amount of an unspent balance sitting on in cash that's ready to spend on fixed assets, and it's got to be reconciled. So that's a key thing to understand and reconcile and get right, because if the fund accounting on this goes wrong and you end up ultimately with the wrong balance on the fixed asset fund, by implication you've got the wrong balance on your revenue reserves, and then therefore you're not reporting the right number for how much available funds the Academy Trust has at the year end. So it's important that that's reconciled. So over to my next slide. This just demonstrates what we've got then on the balance sheet. So you can see on the bottom half of the balance sheet those breakdown of funds there. So the 10,125, which I've circled, that we just looked at, and the other revenue funds that we've just been through. So in note 19, which is cross-referenced to there in the Coketown, though the elements of note 19 I've just been through on the previous slides that break down all of those figures into more detail. So the fixed asset fund there, you can see on the bottom half of the balance sheet, and how that relates to the fixed assets on the top half of the balance sheet. And so the two numbers there, circles, they should either be equal, or if there's a difference, there should be a reconciled reason for the difference. So over to my next slide. So looking at transfers between funds. So what kind of reasons do we have for transfers between funds? So I've given the reasons already for the most common two transfers, those purchases out of GAG funds, or maybe other revenue pots such as unrestricted funds, or fixed assets, or maybe some capital funds are actually used for revenue expenditure for things like refurbishment, and highlighted also that the revenue funds normally don't become negative other than the local government pension scheme. So those are the key transfers, but again, important to understand what supports those transfers and have a reconciled figure for that. So this slide picks up some more detail on the balance sheet on the revenue reserve side. So previously I circled the fixed asset fund balance. This is looking at the revenue reserve. So the revenue reserves are split between two items: the restricted income fund and the unrestricted income funds. Now, as we saw when we saw the breakdown in note 19 of those restricted income funds, although they are ring-fenced, in this Coketown example, most of it is actually GAG money carried forward, and so it's very flexible and can be used for most things within the Academy Trust. And the unrestricted funds are obviously completely flexible. And so when we're talking about free reserves, available reserves, how much money do we have at the year end, we're typically talking about those two numbers together. And so it's the 464 plus the 278. So Coketown has got 742,000 of revenue reserves at the year end and available funds. That's a really important number for the accounts, and probably the most important number in the accounts to understand how much available funds do we have at the year end. And you can see if on this example, if you compare it to last year, it's significantly higher than it was in the previous year. So if you were Coketown in 2019, you might think finances are getting very tight. You've really got to watch out here, because there's only just over 250,000 of funds, which is quite tight in relation to the size of the trust. However, in this year, the movement on those funds is actually 489,000, so a big increase in revenue reserves in the year. So actually, in this fictitious Coketown example, they've had an extremely good year and made a big surplus on the revenue funds in the year. And that's actually put it in a much stronger financial position of 742,000. So it's really important that that makes sense in terms of the underlying finances and management accounts. These numbers should be meaningful in terms of the underlying management accounts of the Academy Trusts and the sort of surpluses that you've been reporting in the year. So if you were preparing this set of accounts for Coketown Academy Trust and came out with these results, those numbers should really be meaningful in that they would have related to the kind of surpluses that you were reporting all through the year, and the fact that you're expecting to end the year in a much stronger financial position and with a lot more funds. So over to my next slide. Just looking at the funds by school. So if you're a multi-academy trust, you have to split down the funds by the individual schools. And again, we've got a copy and paste of the note to the Coketown accounts here, which breaks down the fund balances by school. And these, again, they capture those restricted revenue funds and the unrestricted funds here in the fund balances by school. So these are made up of unrestricted funds, GAG, startup, other things that are reported in this fund balance by school. And you can see it comes down to that 742,000 figure of revenue funds across the schools that I just mentioned. And in this case, we've got both positive and negative funds. So if there are individual school funds in deficit, you've got to give an explanation for that in the footnote to this note. And it's important that this sort of ties back to your management account. So again, schools will often very closely track the amount of reserves that they've got individually, and that should then relate to the number in this note to the accounts, and so should make sense in terms of what you've been telling the individual schools that they've got as reserves during the year. Some academy trusts do have a pooled reserves policy, and now it's permitted that if you are pooling your reserves and therefore reserves aren't there's no reserves held at the individual school level, it's all held at a overall trust level, that you can just report at a trust level and don't have to report zero balances for the individual schools. So over to my next slide. This is really the final points that I wanted to make on the funds. So having been through all that and understood what the various funds relate to and how that note's potentially put together, I just want to highlight the checks that are important to perform then before finalising the funds note in the accounts and the fund accounting within a set of statutory financial statements. And there's a series of checks here that are all important to know the answers to before finalising. So the first question is, are there any unspent capital funds at the year end? So if you've say got unspent SIF or carried forward to full formula capital, it's important to make sure that that's reconciled and that that's sitting within the fixed asset fund as cash, and therefore the difference between your fixed asset fund and the net book value of fixed assets is that unspent cash balance, which is a reconciled figure. And then in terms of the other funds that are carried forward, all the revenue funds and the balances on the fund, it's important to perform checks that those fund balances are in line with expectations. So if the numbers that come out show that you're carrying forward 51,000 of pupil premium funds, is that a known figure? Is that reconciled? Does that make sense in the context of your knowledge of the Academy Trust? So review those balances carried forward. It's also important to look at where fixed assets during the year have been funded from and make sure that makes sense in terms of the notes to the account. So typically in any year you might have fixed assets that are funded from SIF money, you might have funded some of them from your GAG money. So it's important to go through those fixed asset additions for the year, understand where all of those additions have been funded from, and then make sure that makes sense in terms of the notes to the account. So in Coketown's example, we'd have a balance of fixed asset additions for the year, and then we go through and say, well, 10,000 was funded from GAG in that case, 200,000 was funded from SIF money, etc., and go through it and make sure it's all accounted for and reconciled back to the accounts. And then that links into then being able to explain all of the transfers between funds. So all of the transfers between funds should be an explained figure. So why are you transferring money from one fund to another? Either because you're purchasing fixed assets out of a different fund, etc. Do those transfers make sense, and are they fully explained? Also important to check, as I've said, that a logical amount of expenditures are allocated to each income fund. So make sure you've not got any income funds that are sitting there with zero expenditure allocated to them when they've clearly got direct costs. So making sure things are matched off, as we've said earlier. And then the final and potentially the most important check is sense checking the overall amount of revenue reserves that you're carrying forward as a Academy Trust. So in the example we looked at, that's that 742. That's probably the most important number in the accounts. Does that number make sense? Do you feel that that's the figure as you've been reporting in the year in the management accounts makes sense? That's how much available funds that you've got at the Academy Trust. If that doesn't make sense, there could have been an issue with how you're allocating funds or putting things in the fixed asset fund, and it could be a mechanical error rather than something else. So make sure that that number is meaningful in the set of Academy Trust accounts. And that's it. So that's everything I wanted to cover on fund accounting. As I say, it's a really important area of the financial statements to get right, because of the complexities of how it's put together in a set of Academy accounts and reported on with the level of detail. It is often, unfortunately, an area we see a lot of errors in a set of Academy accounts. So it is important to perform all those checks when you're finalising your draft Academy accounts. Thank you.